Good afternoon and welcome to MF Corner. I'm Sumera Abdi and I'm coming to you live from my home in Mumbai. With me, my guest this afternoon is Feroze Azeez of Anand Rathi Private Wealth Management. Feroze is his home too, and well, both our buildings are quarantined, so we're in lockdown mode. But on mutual funds, there's a lot to discuss actually today. So Feroze, thanks very much for sparing your time this afternoon. One, of course, is that the AMFI data, or the mutual fund flows data for the month of March, has just been released, and pretty interesting trends actually over there. And the second part remains that, what should be the treatment of debt funds, given that there's this pandemic outbreak, and because of that we've seen a subsequent shutdown and a lot of the corporates work from home and so on. But first, let's talk about the flows data for March. Here we've seen on the equity side, the flows have come in for headline equity funds in excess of 11,000 crore rupees. Now, this is a very, very good and healthy indication. This means that a lot of the investors who would earlier get freaked out when they saw volatility in the market are now keeping the faith, and they understand the logic that you should buy at lows and then stay invested for the longer term. So that's the happening part, and that's the good news. Now for the not so good news, and which is the credit risk funds. Now here, of course, it was expected that outflows would continue, and the outflows have continued. The only thing being that the outflows are in excess of 5,500 crore rupees. Now, this is a category which retail investors have shunned ever since we saw the Island FS episode come to light. And, this is a trend also which experts tell us is likely to continue as well. Now, a reason why we are seeing a heightened outflow this month could possibly be that there's a fear that, there could be further defaults as well in the ongoing months because of the shutdown that we are seeing right now. The part that concerns me the most about the flows data this month is the liquid funds category, because here the outflow is in excess of 1 lakh crore rupees. Now, of course, one of the points to consider is that it is the year end, and every quarter end and year end is when we see a lot of volatility and fluctuations in the kind of flows that liquid funds see, and which is because a lot of the large corporates use this category to keep their cash, and therefore they either redeem or flow in money depending on what is their own requirement. But this 1 lakh crore of redemption in just the month of March is a little unusual and higher than what we would have expected. The other thing that we want to talk about is that what all of this is going to mean for debt funds. So Feroze, first let me come to you on the flows itself. Are you surprised that equity is held up? SIP is also likely to have held up. I haven't got the number yet. And does it concern you that the debt category and even duration funds for that matter are seeing very, very high outflows?
Yes, Sumera, I think I'm very, very excited to see the wonderful flows on the equity side. Like you rightly pointed out, in the past, it was always just the opposite. The mutual fund investors would purchase at highs and sell at lows, which I think has got corrected logically so. I think there are 2-3 reasons for it. One big reason is I think the investor education program over the last 4, 5, 7 years from the previous sharp falls has definitely contributed to this sanity in the retail investor. The second is I think the hot money, the HNI money, has moved to other platforms like PMSs and AIFs. And they've moved out from mutual funds to the extent of 4, 5, 6 lakh crores, which is almost 50% of what the equity mutual fund basket has today. So point 2, which I'm making, is that HNI money, which was generally the more agile money, has left the mutual fund investors more stable, which I think is very good. And I think, of course, like you rightly again said, that on the credit risk funds, the outflows continue. So even if there is no credit event to happen, just because of this outflow, and the fund manager having to sell those bonds at discount could have a larger dent to people who stay back. And I think long-term investors should never be pained due to short-term investors, but that could happen in this category and several other fund categories as well. So I think that's very concerning. And liquid funds, of course, given the lockdown and March, we have seen huge corporate outflows, and that's where the maximum institutional investing happens. And that's going to be the most volatile in times of uncertainty when their revenues, corporate revenues, are lower. They would definitely want to use up their reserves rather than their revenues. So that's my take on the numbers which you just showed up.
Yeah. Absolutely, Feroze. It's like a vicious circle that feeds on itself, right? But let's talk about liquid funds a little bit, because the March fact sheets of a lot of the schemes are out. I haven't gotten through all of them, but some of them, and especially the larger liquid funds, are showing a negative cash balance. Is that a point of worry? And specifically from the point of view of retail investors, should they be worried?
See, if you're in a liquid fund, I personally think this negative cash is a little surprise to me as well. Let me be honest, because negative cash is basically nothing but a borrowing, which a fund manager is permitted to actually use that borrowing line up to 20%. So some of these funds would have utilized that because liquidity was very, very tight, especially in the last month, given the kind of volatility on equity side as well. So people were very, very cash crunched. So the debt market was very dry relative to how active it is during March year ends. So that's the reason why some mutual funds would have actually borrowed and furnished their redemptions promptly rather than selling some bonds at a discount, which I think is very investor centric. And the second big reason why this would have happened is because I think the redemption size itself does not actually merit the WDM segment, the wholesale debt market segment might not be so deep to furnish on a given particular day such large quantities of transactions in specific bonds. So that I think in the liquid fund category will correct itself without too much of a dent to the investors who stay back. But in other categories, negative cash could be a big concern to people who are in that fund.
Okay, so basically this is also monitorable for investors to check in their current portfolios. The other thing, Feroze, is that, according to SEBI rules, a scheme can borrow only 20%, right, of its AUM. Now, this is a pile that's anyway shrinking quite rapidly. A lot of the schemes are nearing this 20% mark. What happens when they touch it and, they can't tap any other source to generate this kind of liquidity? What happens to the scheme then?
See, firstly, there are two problems or two things to keep in mind. One is the 20% limit, and the other is the 6-month period till which this limit could be. Now, and I think the 6-month period is reasonably generous given the current circumstance. Things should ease out and dust should settle in that 6-month period, hopefully. But I think if you breach the 20% mark, of course, the fund manager has the right to sell the bonds. And that's where sometimes you don't want to sell a security lower than the price which you've marked in your NAV or you think is the fair price. So for the differential, let's assume a specific fund has already breached the limit of 20% and he gets another 5% more redemption, or she gets, as a fund manager, gets 5% more redemption. At least for the incremental 5%, the fund manager will have no choice to go back and do what he or she did for the first 20, but will have to sell these 5% and can hold the rest of the 20% negative cash for 6 months and sell it at rational prices rather than book losses for some irrational illiquidity in the marketplace. So to answer your pointed question, Sumera, so if they supersede 20%, I think fund managers will sell that portion of the portfolio to furnish redemptions. And I'm sure fund managers must be working round the clock to automatically bring down this limit down to have a headroom of borrowing. And this will not be a very static number.
Okay. Fair point. Let's talk now about credit risk funds. But Feroze, before I ask you, I want to just, for the benefit of our viewers who might be watching, credit risk funds are funds which invest a maximum of 65% in AA and below paper, right? So that's their mandate, and hence the name credit risk. So they take on the risk, the credit risk from the issuer. So they give money to companies, and the companies are supposed to service it. Now over here, Feroze, my question to you is, this is a category that has been seeing outflows for the longest time now. This month as well, outflows have spiked quite a bit to 5,500 crore rupees. Is there a worry for those investors who are still invested in credit risk funds? What is the worry and what should they do?
See, Sumera, there are two worries. One worry is that the bonds which you end up owning actually default. That's one worry, which is the conventional worry. When you buy a bond, you're worried whether the issuer will be able to pay back or not. And I think that's a smaller worry. Because there are so many credit risk funds which actually have structured deals where there's collateral in certain cases. There is a lot of due diligence which a fund manager does before he lends money to a company which is not AAA rated or not rated so well. So I'm sure fund managers have done a very, very good job to choose those bonds very wisely that they don't default. But the problem actually is of everybody redeeming their money and these bonds actually ending up defaulting only because there's nobody else wanting to lend to them. So as a corporate, you're okay. But because of there is a run on the money, on the corporate, and there's nobody else lending for a rollover, then actually, in spite of the corporate doing well, they will default because there's nobody else lending and there is no renewal possible or a refinancing opportunity, which is how the debt actually works. Most corporates, when they borrow, they don't actually repay it. It gets refinanced in most cases in a span of 15, 20 days, 1 month. So it's more of a cash flow transaction. So that's the second portion of the money. If everybody redeems the money, like for example, if you went to one of the strongest banks and all depositors ask for their money back on a particular day, then that bank will go default in spite of its business having done well because of asset liability mismatch. So that's the second portion, which is what worries me. I have been recommending credit risk fund for a reasonable portion of the time, but the problem is everybody else redeeming and you staying back could be a scary one.
That's true, Feroze. And the other problem over here is that a lot of the mutual fund schemes or the fund managers actually do a lot of private placement. Now, we know that in any case, valuation has always been a bit of a hazy area in this regard. Does that become hazier still now?
Yes, see, Sumera, you're absolutely right. I think you hit the nail on the head. And this is what every investor should understand very clearly, especially in times where you want to be more careful. It's very important for you to understand this. Point is that if you are doing a debt private placement, those are not going to be actively traded. So when the NAV gets computed in certain funds, especially credit risk funds or even some bond funds where the bonds are not very extensively traded, there is something called the mark to model, not mark to market, because if there is no market and if I'm the only buyer of the bond, it's but obvious that there's nobody else buying and selling. So if nobody else is buying and selling, then I have to value it on the basis of a model rather than the actual price. Unlike in equity, the price discovery is every millisecond, most on top stocks. So that is actually a traded price. Whereas in debt funds, quite a few funds will have 40-50% of their portfolios marked to model rather than marked to market. So it becomes a little inefficient, not because the fund manager does not want to market to efficient levels, but if there's no trade, then there is a judgment of a model. That's one thing which should be understood. So some portion of debt funds will have mark to model rather than mark to market, because in debt market, every security or most securities are unique. In spite of you buying the bond from the same corporate, you will have bonds which are unique, unique timeframes, unique terms, unique coupons. So all of them are unique. So marking them to find out the NAV is a very complex task, and it is not as efficient as in the case of equity.
Feroze, you've highlighted a very, very important point, and I want to take up on this, but we need to take a very quick break. On the other side, we'll talk about, why mark to model is something that, investors who are planning to stay back in credit risk funds need to monitor very, very carefully. This is an important point and one that our viewers need to understand. A very quick break for now. We'll be right back. Hi, welcome back. You're watching the MF Corner, and with me is Feroze Azeez of Anand Rathi Private Wealth Management. Now, before the break, Feroze was telling us this very important distinction about how the bonds which are held by credit risk funds are valued. Now, one is that if an AMC has done a private placement, which means that there is a specific kind of a bond which has been curated just for that AMC, there is no other way to value it, right? They have to value it with its closest peer. Now, within the bond market, there are distinctions also based on when the maturity is, whether it's 6 months, a year, 2 years, and therefore an approximate value is derived. So when the NAV of a credit risk fund is being computed, this mark-to-model price reflects in that NAV. However, so if somebody was to redeem today in a credit risk fund, that NAV would reflect that mark-to-model rate. However, should a default happen, or should the fund manager be forced to start selling securities one by one in a tizzy to sort of make good the redemptions that are coming their way, eventually they will have to do a mark-to-market when they start selling their securities, and the investor which has got left behind in the credit risk fund may be the loser in the end. Feroze, have I got that right, the understanding?
You articulated it very well, and I'm glad that you've paraphrased it better than me. And I think you're absolutely bang on. But only one point I would want to make after hearing your explanation is that credit risk funds, there are different kinds of credit risk funds. There are some funds, credit risk funds, who have managed this very well. For example, an ICICI credit risk fund. So it's not just about one category, it's about which fund you own and you being able to understand the fund that investor owns. And it's not just a problem of the credit risk fund, because in debt markets, the diversity. Now, for example, the S-Bank episode, everybody was assuming that they have a similar bond. Even an 81 bond purchaser would not actually know of this clause. So point is understand your fund better, and then take a decision. The problem is sometimes more magnified in credit risk funds. There are other funds also who are, unfortunately, the fund manager has no choice. He wants to work in his investors' interest. There's just the uncertainty which can create problems. That's the point I would want to clarify.
Yeah, absolutely. It's not the intent we're doubting, it's the environment and which sometimes forces you to take tough decisions. Feroze, the other thing is that SEBI has already told credit rating agencies that because of the moratorium period which has been announced by the Reserve Bank, the lockdown, etc., any COVID-19 related default should not be categorized as a default as such. Now, therefore, should a default happen in a credit risk fund, or rather that, they don't service it because of the moratorium, it's not technically a default as such, mutual funds cannot side pocket it because technically they can only do it when the rating goes to junk. Therefore, what is the option left for the scheme? I mean, does that security remain as is in the books of that particular scheme, or do they take some action on it?
See, I think, yes, absolutely. So there is a lot of stuff which is going to emerge over the next couple of months. A lot of regulatory changes, a lot of flexibility given. Like you pointed out, if there's an NBFC, if it's given the moratorium, and if it defaults, it's actually not a default, then the side pocketing is not possible. So if investors end up panicking and removing money, so I think fund managers will actually take a decision of marking that security at unfairly low prices, so that people don't rush to go out and harm the investors who stay back. So one action which the fund manager has, side pocketing is out of question because it's not downgraded. If the other action is to mark it down at a price such that it does not leave much for a person to take back when he redeems in panic. So that's one action which we have seen fund managers doing, because side pocketing is an altogether different exercise, and here you can't even side pocket. There, when you side pocketed, you have to reverse the bonuses or bonuses given to fund managers. So there's a lot of implications. So I think that's what they would do: mark it down in value so that nobody takes home the full value of the supposedly defaulted debenture, which might not get categorized that way.
Okay, and we've seen that recently in the case of Vodafone Idea, we've seen Franklin actually mark it down to zero, as a prudent measure. Feroze, the last thing on my mind is, of course, this whole thing of moratorium. Right now, so far, NBFCs, which by the way, mutual funds have the largest sectoral exposure to NBFCs, right? So far, NBFCs are not covered under the moratorium that the Reserve Bank has announced. But just this morning, my colleague Lata spoke to the SBI MD, who indicated that, this was something that was under active consideration. Now, should the moratorium be extended to include NBFCs as well, which means that NBFCs needn't service their loans for the next 3 months, what happens to the mutual funds who are owning the papers issued by these NBFCs?
See, I think Sumera, you're right, because it is only logical. If an individual who's a borrower of an NBFC gets a 3 months moratorium, and if the NBFC has to service the interest, where does it bring the money from? Because it's a chain, right? Because NBFCs lend it to individuals, like for example, a housing development or a HFC. Housing Finance Company, which is an NBFC, is giving money for EMIs to be received, and their back-to-back payments in terms of interest obligations has to be made. So I think it is only logical to complete the chain. Of course, things will emerge, and I think I also saw the interview Lata did with Mr. Kara. So I think that's only logical, and I'm glad they're actively considering that. Then coming to the concern which a mutual fund investor can have, but I think it's if the company is strong, it doesn't matter, because it is not an interest waiver, both in the case of individuals and it's definitely in the case of NBFCs. It's not going to be 3 months of interest waiver which the fund manager, fund investors will have to take a brunt of. So it will only be a delay. Anyways, the dividend options is not something which people choose in debt funds as much. They do systematic withdrawal plans. So I don't see a large dent in the mutual fund investors' return, because it is deferred, not exempted for the NBFC to get away not paying interest, just like individuals also have to pay an interest on the interest as well. So it will get compounded. So it will not be denting the return of the mutual fund investor. But one thing which really bothers me in funds which are having a large redemption is the proportions going up. See, like we've had this problem in several funds. If I have to name a UTI credit risk fund, had invested a very small portion in Vodafone. If I remember, recollect right, Vodafone it was. But as redemptions kept progressing, a 5,000 crore fund became a 1,200 crore fund. And then the proportions of the bond became significantly more. That's what I think is very worrisome in these kind of liquidity crisis. And it is in debt, you only make 1-2% more. Taking this anxiety for that 2%, 3% more per year, that too is not may not be worth it.
Yeah, I take your point entirely, Feroze, and thanks very much. The objective of the show, of course, was not to alarm viewers, but to just make them aware that they need to go back and relook at their portfolios very, very closely to see where there may be some, loose chinks in the armor. Feroze, thanks very much as always for joining in and sharing this wealth of data with us.